Compound is up massively in the last month. We are looking at 160%, while Bitcoin during the same time only went up by 17%. Now, this is not my first video on Compound. In the first video, I was talking about trading volume and how the elevated trading volume, the high attention on the Comp token, might lead to temporarily elevated prices that then can turn around again, right? A lot of attention on a token means higher prices. When attention moves to the next cryptocurrency, the capital also follows that. Now, in this video, we are going to look beyond just that. So this is the trading volume, and this is the price rising in accordance with this trading volume, with this heightened attention. When trading volume comes down, this rally shall return at some point as well, back to more normalized levels. But I want to do this video a bit more technical. I will be looking at a back-tested approach, at a strategy of buying and selling the Comp token that historically worked well in the past. So the basics of that strategy are pretty straightforward. We're simply just buying whenever the price is above a moving average, and we are selling, or we are betting on falling prices whenever the price is below the moving average. The reason why I like this strategy so much is because it works for many cryptocurrencies, and we can optimize around this. We can find out how well does it actually work. So let's look again at the Comp chart. Let's remove the trading volume this time. And we all know that at some point this rally will turn around again, but the question is really at what point? And so here's a simple moving average as an example. It's the 100-day simple moving average. And we can toy around with that duration, right? We can make it shorter, then the moving average line gets closer and closer to the price. Right now we are at the 60-day, it's already pretty close. Now we're going to the 40-day, it's getting closer and closer, right? Let's go maybe to 150, a much longer duration, 150 days. Now the idea would be that you want to be buying in whenever the price is above, and you want to be selling or betting on falling prices whenever the price is below. And we only look at the price at the end of the day because this is daily data, right? So end of the day here in detail means UTC time zone midnight. So sometimes we have our failed signals here, right? We get in just in order to then go out again at similar price levels. Then it happens again and again and again. For this particular moving average, right, we are crashing temporarily 40%, then recover again. We don't take advantage of these fluctuations at all, right? Ideally, you want to be buying back in much earlier. And you also want to reduce the number of failed signals. So really, we can't just guess here what the best duration of a moving average is. But we can test this. We can run a back test and can find out, even if we include the trading fees, how well would trading according to the strategy work if we take, for example, the 10-day moving average, or the 50-day, or the 100-day. For this video, I've done 400 simulations. I've back tested 200 simple moving averages and 200 exponential moving averages. They are slightly different. And so let's look at the sheet. The data starts in June of 2020. And for the first 200 days, we don't trade at all because that's the time duration we need in order to calculate the very first 200-day SMA. So then on the 10th of January 2021, we start trading, and we do this all the way to today, the 12th of July 2023. And unfortunately, during this particular time period, the Comp token didn't do too well, right? It fell from $194 all the way down to $68. So buying and holding annualized per annum would have given us minus 34%. Now let's run the back test. Let's do both. We buy whenever the price is above, or we also bet on falling prices whenever the price is below the moving average. We start with an initial capital of $1,000. And in this particular example, let's just play with free trading on centralized exchanges. We could also change this somehow, right? If you trade on decentralized exchanges, 0.2, 0.3%. You can also add a gas fee if we want this. But let's simply just look at the raw data. What's the best moving average if we remove all of those fees? And then we've got our Excel macro over here. And so let's run that. 400 simulations of buying and selling. And we can see how the data here gets populated. So this takes a bit. It takes roughly 30 seconds or so to run, right? It's 400 back tests. 400 times the program is now running through the entire history, simulating buying and selling and trying to find out what is really the best historically. And we can already see right here on the B column, we've got the duration. Then in C, we've got the best simple moving average annualized performance. And in D, the best exponential moving average annualized performance as well. And a lot of those returns are better than buying and holding, right? That's the minimum we should expect. Ideally, we want to get positive return, and we actually do get this. Now we can also look at this in chart form, and that's this chart over here. So on the x-axis, we've got the duration of the moving average, and on the y-axis, we've got the annualized performance. So we see here two types of moving averages. So in turquoise, it's the simple moving average. In red, it's the exponential moving average. And we see two exponential moving averages that work pretty well. The 14-day and the 47-day. And for the SMA, the simple moving average, you only see one that worked pretty well. It's the 43. So in order to get somewhat of a balanced view, I think instead of taking those two moving averages, let's take the EMA, that's 14-day, and let's take the SMA, that's 43. So let's plot those two on the chart. But first, before we do this, let's first look at how would such a performance look over time. So for that, we have to change the sheet slightly again. So the 14-day EMA, that's what we want to look at. That's over here. And for the SMA, the 43 over here. And now we can look at the charts over time. This is the compound price over time in white, and then the best simple moving average return on a linear scale. We started with $1,000 and we go up above 20,000. Now this is a linear scale. We can also look at this on a logarithmic scale. That's what that looks like. So currently it looks like we are long, right? We are betting on rising prices. We do take advantage of the recent rally, but we also see when compound tends to go down, we make money from this. We are betting on falling prices here. So pretty constant, nice outperformance. A logarithmic scale means that here these horizontal lines, right, they're 10 axes from one another. So those two are basically the same kinds of charts. It's the same data, but here we have just a normal scale, $5,000 from one another. This is logarithmic, so we can see a bit better what happened in the early days. But it's the same data. Then let's look at the exponential moving average return. Again, compound can be barely seen because the performance of the backtest is simply so good. And then again, on a logarithmic scale, this is what we are seeing. Pretty nice, constant outperformance as well. Recently being long, betting on rising prices. Also here with the EMA, close to 20,000, 22,000 to be more exact, since the beginning of 2021. So 1.5 years of trading. So let's now look at this in a chart. So here we go. The exponential moving average, which is shorter in duration, and the simple moving average. And the idea is we buy whenever we go above and we sell whenever we go below. And since the return of those two moving averages aren't that different, the annualized returns, we can pretty much make that decision on the fly if we already want to sell when the EMA gets crossed, or if we want to wait and be a bit more conservative, do less trades and wait for the SMA to be crossed. It's very interesting to look at things like this because in general, these approaches work very well for crypto and they work well on several levels. So the first level where this works really well is the duration of the moving average doesn't really matter even that much if we compare this to buying and holding. Buying and holding here is the black line. So no matter what duration you actually pick, if you timed the market to a certain degree, you would outperform buying and holding. So this is a very good indication that this is not just random, right? If the strategy would perform totally random and we would only cherry pick, then the results should be somewhat hovering around the buying and holding line, right? Some performances would be worse, some would be better, but this is not what we are seeing. We see in aggregate the performances are better than buying and holding. So following the trend as a general strategy seems to be working. So that's the first thing why I like this. The second is this strategy does not only work for Compound. This strategy works also for Bitcoin, it works for Ethereum, it works for a vast majority of the altcoins. I'd say it works in around 90% of the cases. Most altcoins are very, very cyclical. And I have made a lot of those back tests, right? Here in the premium membership, you cannot only look at the best moving averages for different assets. You cannot only download a script that plots the best moving averages for all of those altcoins. You can also download those Excel sheets. And you can get alerts whenever the moving averages get crossed. That's here in Telegram, in the indicator alerts channel. So that's why I like crypto that much. Crypto is still a very inefficient market. You can generate outsized performance without too much complexity. Now, this is one of many backtests I've done over the years. Backtests on different trading approaches, backtests on different assets. And that's, I think, what makes this channel different from others. We only use approaches that historically worked well. And even though past performance is no guarantee for future performance, I think it's the next best thing that we have. We simply work with the assumption that psychology doesn't change too much over time. When people are down 80%, they're likely going to react very similar, no matter if this was in 2016 or in 2019 or in 2022. If an altcoin suddenly has a spike in attention, does it make sense to buy? And if yes, under what circumstances? Those kinds of structures don't necessarily change with time. And so we've done all kinds of backtests, and you can download all of those Excel sheets for the different backtests in the premium membership. There are also tutorials specifically for backtesting. How to build such a sheet, how to change such a sheet. All of this is very valuable content, and it is a proven approach that helps to ride those positive waves whenever we are in a bull market, and that helps to protect us whenever we are crashing down. Now, there's more information around the premium membership at thebitcoinstrader.com, a dedicated video on this. And the price isn't that cheap. It's $75 per month. But here's the deal. If you are not happy with the content, if you're not happy with the support in the Telegram channels, if you don't think that you get enough alpha out of this content, then simply message me in the very first week and I'll refund you 100%. So there's zero risk for you. Most people that sign up, they stay signed up because they get more money out of it than they spend. But feel free to simply just try it out yourself. You can watch all the videos, you can download all the Excel sheets. The reason why most people stay subscribed is because of the community. It's because the trading opportunities we share with one another, and it's those opportunities and the timing of those opportunities that make us win over the long run. So check it out. It's thebitcoinstrader.com, 100% risk-free for you. I don't know a reason why you wouldn't try it out.